If you're investing in commercial real estate, understanding how lenders look at deals is extremely important, and there are a few metrics that you need to know if you're getting into this business. These figures can impact the total loan proceeds a lender is willing to issue, how much cash an investor will be able to put in their pocket on a monthly or quarterly basis, and how much risk the borrower and the lender are ultimately taking on. So in this video, I want to highlight what these metrics are, how each of these is calculated, and how these can ultimately impact a commercial real estate deal. So the first metric I want to highlight is the debt service coverage ratio, or DSCR. This metric is calculated by taking the net operating income of a property and dividing this by the annual debt service owed by the borrower, and this essentially measures how many times over the property's net operating income can cover the borrower's required loan payments. And what makes this figure so important to lenders is that this provides a really clear indication of how much cushion a property has to continue making loan payments if the NOI of the property were to decrease in the future. For example, if we were acquiring a property that generated $1 million a year in net operating income and annual debt service on the loan was $800,000, the DSCR on this property would be 1.25x. This also means that the NOI of the property could drop by 20% before investors would need to come out of pocket to pay for debt service costs directly, and a quick way to calculate this is to take 1 minus 1 divided by the debt service coverage ratio, which will get you to that break-even number. This means that if the DSCR was 2.0x, the NOI would need to drop by 50% before the property would reach break-even cash flow. If the DSCR was 1.5x, the NOI would need to drop by 33% before the property would reach break-even cash flow. And if the DSCR was just 1.2x, the NOI would need to drop by just 17% for the property to break even. And because this metric is such a good barometer of risk, lenders will typically set a minimum DSCR figure, which can vary based on the property type and the general risk profile of a deal, but in most cases, this will come in somewhere between about 1.2x and 1.5x. And because higher debt service coverage ratios typically reduce the lender's risk, these will also often come along with more attractive loan terms overall, like extended interest-only periods, prepayment flexibility, and in some cases, even a lower interest rate. Now, the next debt metric I want to highlight is the loan constant. And the loan constant measures the total annual debt service paid by the borrower divided by the total loan amount, essentially measuring the borrower's annual loan payments as a percentage of total proceeds. And because of the principal portion included within each loan payment, the loan constant will actually be higher than the interest rate that you're quoted on a deal, and in some cases significantly higher depending on loan terms. For example, if a borrower were to take out a $5 million loan at a 5% interest rate, amortizing over 30 years, the annual debt service on that loan would be just over $322,000, which would make the loan constant 6.4% or 140 basis points above that interest rate. However, if a borrower were to take out that same $5 million loan, this time at a 3% interest rate, amortizing over 25 years, the annual debt service would drop to just $284,000, but the loan constant would decrease to just 5.7%, which is a 270 basis point jump above that interest rate. This is why in some cases, investors will actually see a lower cash-on-cash return with debt than without it, even if their interest rate is relatively low, and this is what's referred to as negative leverage. If the cap rate on a deal, or the NOI divided by the property value, is lower than the loan constant, this indicates that a deal has negative leverage where the cash-on-cash returns, or the annual cash distributed to investors as a percentage of equity contributions, is lower with debt than without it. And in a positive leverage scenario, the opposite is true, where the cash-on-cash returns will be higher with that debt in place. For example, if an investor were to buy a property for $20 million at a 6% cap rate in an all-cash transaction, that cash-on-cash return in the first year of ownership would also come in at that 6% number. But if that same investor were to finance this acquisition instead with a $15 million loan at an even lower 5% interest rate, amortizing over 25 years, the loan constant on the debt would come in at 7%, and the cash-on-cash return in that first year of ownership would drop to just 3% for that investor. In general, the rule of thumb is that the shorter the amortization period and the lower the interest rate, the higher the spread between the interest rate and the loan constant is going to be, and vice versa. And this is definitely something to consider before going into a deal. Now, the next debt metric I want to highlight in this video is the debt yield. This figure is calculated by dividing the net operating income of a property by the loan amount and measures the NOI yield to the lender as a percentage of the capital they've contributed if they were to have to foreclose on the asset and ultimately operate the property. Now, in most cases, in a foreclosure scenario, the NOI would drop substantially from that starting NOI when loan proceeds were initially issued, which means that for a lender to replace the yield they would have earned if they had to take back an asset, the required debt yield on a loan will typically be significantly higher than the interest rate that's quoted. Minimum debt yields today are typically coming in anywhere from between about 8.5% and 12.5%, again, depending on the property type and the risk profile of the deal, with lenders dividing the property's NOI by their target debt yield percentage to come up with the maximum loan proceeds they're willing to issue on a transaction. Now, last but not least, I want to cover the simplest loan metrics that we'll talk through in this video, and these are the loan to value and loan to cost ratios. The loan to value, or LTV ratio, measures the loan amount divided by the appraised value of a property, which tells a lender how much the property value could fall before the borrower ends up underwater. For example, on a property valued at $20 million, a $15 million loan amount would represent a 75% loan to value ratio, which means that the property's value could drop by 25% before the borrower couldn't pay off that outstanding loan balance when selling that property to a third party. And the loan to cost ratio, or LTC, is a very similar metric, but instead of dividing the loan amount by the appraised value of the property, this metric divides the loan amount by the total cost of the project, including the purchase price, closing costs, and any planned construction costs that are intended to improve the property. This tends to be the most relevant metric for ground-up development projects and major value-add deals where the value of the property at acquisition isn't necessarily indicative of what the value of the property will be in the near future. And for most lenders, maximum LTV and LTC ratios will typically come in somewhere between about 60% and 75%, depending on the deal. Now, there's obviously a lot more to think about when using debt to finance a commercial property acquisition or development project. And if you want to learn more about how these and other loan terms and metrics are factored into a real estate investment analysis, make sure to check out our all-in-one membership training platform, Breaking a CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on commercial real estate debt terms, make sure to hit the like button and let me know. And let me know in the comments if there are any other commercial real estate financing options that you'd like to see covered in more detail in a future video. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.